Sean, it's really good to see you. We have a very important topic today, and it's about how emotional investing can be really costly. We are firmly in bear market territory. Stocks and bonds are sharply negative, and the market has actually lost 1/4 of its value since the beginning of the year. Just to kind of show you what that looks like on the S&P for the past year, look at all that red on the board.
Right.
When we look at charts like this, Sean, and we hear the headlines, it's really hard not to feel anxious. So, what should we be thinking?
Listen, when you look at a chart like this, it's almost all red right now, and this happens from time to time. It depends on your time period. You could look at something that's maybe the last month or last quarter, it's going to be green. But when you start seeing these things like you're looking at now with all this red, lots of times people get very concerned. I get calls from clients saying, "Sean, I've lost $100,000 in my portfolio.
Mhm.
What should I do? Should we go to cash?" And I say, and don't do that. We've already lost 25%. If you go and sell right now and move what you're holding, your investments, your mutual funds, your stocks, your bonds, whatever they are, and then you sell them and you move to cash, what have you done? You've bought high and you've sold low, and you've taken away your opportunity to make that money back, because
Mm,
when those stocks, when those bonds eventually move up again, you're going to get flat footed holding cash and you're going to miss that opportunity. So
mhm.
having a long term strategic plan is really key. And if you think about, what people are asking me is not unusual, right? It's a very emotional thing when you look at the money you've set aside and watching it go up and down. Watching it go up is fine. We all feel really good about that. What
Yep.
happens, Erin, right? When it starts to go down, we start to feel maybe a little bit of panic, a little bit of fear, and then we get really scared. So what happens if you look at this chart right here? Typically, what's going to happen is people are going to start selling when we get towards that bottom point, or maybe halfway there. It's like, I can't take losses anymore. And those are the questions I'm dealing with today. So if you were to go ahead and sell, when do you go back in? That's a really hard thing to do. So what
Right.
happens is people see the low come, and then they say, oh gosh, we start to see a little bit of return. Maybe it's not really going to be lasting. Maybe we're still going to lose more money. So they wait, and they wait a little bit longer. And then they see some long-term growth. They say, you know what, this is a great opportunity. I got to get back in. What did you do? Now you've sold low and you're buying higher. So
Mhm.
having that long-term strategic plan and sticking with it is really key.
Right. It's just so hard not to act emotional because we are humans. What then is the most common question that you're getting right now? You said people are concerned that they should just sell and go to cash.
That's really been the biggest thing, Aaron. People say, Sean, I've lost 25%
Yeah.
in my portfolio. Should we be going to cash? Should we be selling or taking some risk off the table, as we say? And, for some people, maybe that's the right thing to do. Maybe people that are in retirement and they just can't afford to take any more losses. Maybe we start to take some positions down and sell some things. But then I've got a lot of other clients that are much younger. And I say to them, put more money in. What you're doing now, if you are still saving, if you're early in your career, if you're a younger person, put more money in, because you have the opportunity now to buy low and then in the future, hopefully sell high.
Right. I'm going to mess up the quote, but wasn't it Rockefeller who said that the time to buy is when there's blood in the streets or something?
I
I
believe
mean,
you're right.
I'll look it up. So, you are, of course, known for helping people solve complex financial problems. So, what is it that we need to be keeping in mind right now? I value having these conversations, Sean, because just talking about it with you makes me feel less anxious.
I mean, the biggest thing, right now for folks that are in retirement, they're in that preservation phase. There's three phases of retirement: accumulation, preservation, and distribution. Those that are in retirement now are in that preservation piece. And it's really important to have a plan that minimizes these losses that you can get we see big market declines. The flip side is we're living a lot longer these days, and we need to have some growth in there. But you have to strike that balance. So you have to strike the balance between minimizing those losses and preserving what you have, and then trying to get that growth in
Hmm.
the future.
hmm And I just want to underscore one more important point because you did talk about this. Timing the market isn't only about trying to time when you get out, but time when you get back in. And simply by trying to time the market, this graph is from Brookstone Capital Management. They've crunched a $10,000 investment over a 15-year period. And if you miss just the 10 best days, Sean, look at what happens.
It's unbelievable. You
Yeah.
get basically less than half of what you would have if you had stayed fully invested. And here's the thing to remember too. Sometimes people see really bad days and they say, "Oh, we have to sell out." Well, guess what follows the really bad days? Really good days. So
Hmm.
you have to take that ride, if you will. Stay fully invested. Stick with your plan. Be strategic and really, try to stay invested and not um, become emotional in this.
Right.
And
Right.
it's a really hard thing to do. And that's why working with an advisor can really help. I get a lot of people that call me and they're very concerned about what's going on. And I talk them off the ledge, if you will. I say, let's look back at your plan. It's still intact. This is doing what we expect it to do. Let's stick with our knitting.
Yeah, I'm one of those people. Thank you for talking me off the ledge. If somebody, Sean, though, wants to talk about whether they are properly allocated according to their risk tolerance, or if they have any other questions, what's the best way to reach you?
Give us a call, 603-715-2335. That's really the best way to do it. If you want to set up an appointment through our Calendly link, you can go to our website, which is daviswealthmgmt.com. From there, you can see a contact us button. Click on that, and you can set up some time with me for either a call or an in-person meeting.
All right, perfect. Sean, thank you.
Thanks, Erin.